everyone. Welcome to this discussion. My name is Indermeet Gill, and I work in the Growth, Finance and Institutions Practice Group of the World Bank. Well, we have a real treat for you today. Our President, David Malpass, will lead a discussion with a star-studded panel. And it's fitting that David leads this discussion because he's been a tireless and vocal leader on this issue of debt transparency since he became president 2.5 years ago. It's fitting also that we'll have 4 top-notch experts on the panel, and David will actually introduce them. Why this issue is so important. And this is an easy job for me because our macroeconomics global practice has just published an excellent report called Debt Transparency in Developing Economies. And I can say it is excellent because I cannot take any credit for it. The credit should go to David for championing the cause, and to Marcelo Estevan, Dr. Domeland, Diego Rivetti, and their team in the macroeconomics global practice for actually producing the report. And we released the report yesterday, and you can easily find it if you just Google debt transparency in developing economies. So what I want to do now is to give you a 3-minute summary of the report, both as an icebreaker and as an appetizer, because we are hoping that you will read that report. And like I said, it's excellent, and it's excellent for 3 reasons. So first, it is excellent because it has some startling statistics that will make you sit up and pay attention. So I'm going to cite just a few. The first one is that 40% of low-income countries have not published any sovereign debt data during the last 2 years. The second one is that public debt data, when reconciled, have sometimes shown huge discrepancies of up to 30% of GDP. The third one is that 15 low-income countries have collateralized debt, but no details of the terms are published. And this can often lead really quickly to debt distress when some of this information actually comes in view. So for example, in 2016, when loans totaling more than $1 billion were suddenly revealed in Mozambique, that was nearly 10% of the country's GDP, it plunged the country into debt distress. So we have about 12 countries that are now in debt distress and about 44 countries that are at high risk of it. We don't know how many of these would actually be in distress if all of their debts were revealed. Right? Now, poor countries have huge financing needs, and these will be met mostly through debt. So by one measure, these financing needs total nearly $500 billion between 2023 and 2025. Without debt transparency, such big sums mean big dangers. So that's the first reason. The second reason the report is excellent because it outlines a very practical way to think about debt transparency. It says that debt transparency has 3 aspects. The first one is transparency in operations. The second is transparency in legal management. And the third one is transparency in reporting. Especially the third one is very important. And there are 3 parties that can make debt transparent or keep it obscure. The first one, of course, are borrower governments and state-owned firms, both at the center and subnational levels. The second has to be the folks who actually give this debt. These are the creditors, both public and private. And then the third one are international financial institutions like the World Bank and the IMF. Okay. Now, finally, the report is excellent because for the first time, it proposes the high and medium and low priority measures that borrowers, governments, and IFIs can take. So I will just list the 5 or 6 high priority measures, some to be taken by borrowers and 3 to be taken by IFIs. So to increase transparency in debt reporting, governments should publish core public and publicly guaranteed debt statistics regularly. They should also limit and define the scope of confidentiality clauses. To increase transparency in debt operations, borrowers should adopt market-based issuing mechanisms for domestic debt and adopt strict criteria for approving resource-backed loans. To increase transparency in debt management, governments should define criteria for authority to contract debt or to issue guarantees and specify responsibilities of units in charge of executing the debt operations and publish a list of allowed instruments, transactions, and funding sources. By the same token, what IFIs can do is to consolidate their debt databases and support the implementation of integrated debt recording and management systems. It's a big agenda, and I've talked for a long time, but because it's a big agenda, I'm going to hand the mic over to the big guys. So over to you, David.
Thanks very much, Indermit. Good summary, and it's an important report. We've got a panel, a great panel. Carmen Reinhart, Chief Economist of the World Bank Group, my colleague. Also, Lee Buckheit, who is one of the world's most experienced sovereign debt restructuring experts. Joyce Chang, Global Chair of Research at JP Morgan, and Paul Grunwald, Chief Economist at S&P Global Ratings. Just as a start in, I want to make the point that the world actually is very challenging. I'm just back from the G20 Leaders Summit in Rome, and I made the point, as others did, that we face not only the pandemic, but also rising inflation in a lot of countries, the supply chain challenges, the energy crisis in Europe, the rise in oil prices and other energy prices that's putting inflation into developing countries. Very challenging from a debt standpoint in developing countries. That's the focus of our conversation today. The World Bank is deeply engaged in the issues of debt in developing countries, with the purpose being to try to have more growth rates in developing countries, faster growth, and better connection between investments and the debt that goes along with those investments. This is made more challenging by the size of the debt. We did a report a month or so ago that showed $860 billion of debt in the low-income countries. So even the poorest countries in the world have $860 billion of debt, external debt, not counting their bank debt that the governments take out inside their own countries. This is giant. And the report that just came out yesterday shows this, that, as Indermit was describing, 30% hidden debt, if we want to call it that, or debt that's not really fully recorded in the various statistics that are kept track of. This is at a time when the world, many of the countries, and Joyce was telling our group just before we came on here that there are rate hikes in quite a few of the developing countries already. So this puts added strain on the economic outlook, but it also means that countries are able to begin adjusting to the new inflation environment that's out there. So I hope what we can do today is focus on debt transparency, whether it's important, what the aspects of that are, and how the debt challenge can work its way through the system over the next 5 years. We're all trying to avoid a lost decade from the standpoint of debt. So with that, let me go first to a question to Joyce. As I mentioned, Joyce is Global Chair of Research at JP Morgan and a friend for a long time, and engaged daily in markets. So how do you think about transparency? Is it important as you analyze the prospects for a country, and this idea that there might be 30% more debt than is actually being recorded? How does that affect your thinking about various markets? Thanks for joining, Joyce.
No, thank you, David, for having me. And it's great to be with just so many experts who've looked at this topic. I mean, the transparency is really important to the private sector. And I think one of the issues when the common framework was rolled out was that there was a sense that there was a lot of stalling and no information sharing. And that made the whole discussion about voluntary mechanisms, I think, very hard for the private sector to understand. So, look, the private sector has obligations to its shareholders, its investors on the transparency. And a lot of the questions that we will get is, how do we aggregate the different categories of debt? The bilateral creditor debt, the private sector debt, the contingent liabilities. Where is there an implicit government guarantee, as opposed to an explicit government guarantee? And then, with every sovereign crisis, it usually emanates from the banking system. So an understanding of that. There's also a whole focus on, quasi-sovereign debt, versus which is sometimes called corporate debt, but there's an implicit government guarantee. And we've seen these numbers really balloon. We've had record debt issuance from the sovereign and on the emerging markets, corporate quasi-sovereign side during this pandemic because of the low interest rates. I mean, last year you had 230 billion of EM sovereign debt issuance, more than 500 billion of EM corporate debt issuance, with a good component of that that's quasi-sovereign. So I think for a country to be investable, you need the transparency and you need to have the ways in which you can actually understand the different categories of debt and what the government could be obligated to really implicitly back at a time of crisis.
Thanks, and I hope we can have a roundtable kind of this panel. Let me turn to Lee, or I'll preface. Some of the terms that I hope people will use are collateralized debt. So that means if I lend to if savers of the world lend to a government or even to I guess quasi sovereign debt and a state-owned enterprise and requires that there be collateral set aside in the form of actual products. It's hard to know the relative price of the various items, and it's also very hard to then restructure the debt if the country runs into sustainability problems, and that is exacerbated by non-disclosure clauses if people can't see inside the contract. So Lee, will you give us a briefing on these and maybe ask question to Joyce if you want to, however we want to work it as a panel. Thanks, Lee.
Yes, thank you, David, and wonderful to be with you folks. One of the extraordinary statistics in this report was that 10% of sub-Saharan African debt incurred recently has been of the type you described, collateralized. And it very often is not what you would think the connotation of the word collateral brings. That is a pledge of an asset. These transactions can be and are structured as, for example, forward sales of a primary commodity, so that the lender, quote unquote, buyer, will argue that it isn't debt at all. It should not, therefore, be restructured in connection with the country's debt, maybe not even reported as debt. And yet it has the practical effect of that. Traditional repos are economically the equivalent of secured borrowing. It has several implications to the extent that the country has allocated a significant portion of its future revenue toward the repayment of one creditor. It follows that that revenue is not going to be available for all the others. And therefore, anyone lending on an unsecured basis to that sovereign is probably doing so without a full understanding of the debt servicing capacity of the sovereign in the future. That will result, at the very least, in mispricing of the debt. It also renders the restructuring of that debt stock particularly difficult, because the secured lender or the buyer, the future buyer of the commodities, may well argue they have a security interest governed by the laws of England or New York, and they can always go and foreclose on that, and therefore they must be exempted. So this problem, to the extent that it is growing in significance, and it appears to be growing in significance, represents, I think, a serious risk to the system.
Thanks. Yeah, so debt for the low-income countries is up 12%, even though there were two major initiatives by the G20 to try to provide debt relief, the DSSI and the Common Framework. So DSSI is debt debt service suspension initiative that was invoked in 2020, but didn't have as broad a coverage as had been sought. And now the common framework, which is being applied now to Chad, Ethiopia, and Zambia. We'll come back to those in a minute, but I want to pick up on the point that Lee just made and ask Paul, how S&P, I know this is not your chief economist, Paul, but S&P does ratings of countries and of bonds. I think that's the way I think about it. And how does it do that if it's the case that, as the report shows, that for some countries, it might be 30% more debt than's actually been disclosed. And even for those that disclose debt, which are not that many, which are not all the countries, there are non-disclosure clauses on some of that debt. So even of the amounts of debt that are disclosed, sometimes the terms and the covenants are not disclosed. So how do you handle that in S&P?
Well, first, hi, David and everyone. Thanks for inviting me to the panel. Let me start out by saying that S&P Global is 100% behind these initiatives to improve the transparency of debt. But you're right, we have a sovereign team. The sovereign team currently has 137 sovereign ratings outstanding. So we're missing kind of the lower end of the tail. So perhaps part of this problem is not in the rated universe. But just as a reminder to everyone, the idea behind a credit rating is not to predict a default. It's our opinion on the ability of the borrower to repay their debts in full and on time. But you're absolutely right about some countries not having a full set of data. That would be the ideal state. But our sovereign team for the 137 countries that we do rate, they're comfortable with the information that we have, and they think that's sufficient to determine a rating. When the committees get together and do a sovereign rating, they look at a number of factors. And if they see that there are inconsistencies in the data, the errors and omissions, large errors and omissions is one, or maybe there are, inconsistencies or historical patterns that don't always make sense. These rating committees are allowed to, make an adjustment to the ratings downward in this particular case. So there are a few channels through which they can do that. There's a fiscal pillar, there's a institutional pillar, and there's also some discretion around the final determination of the rating itself. It's not a totally mechanical process, but the sovereign teams are aware of the issue, and this lack of transparency is embedded in the ratings, and it tends to be correlated with the lower credits. The higher rated credits tend to have, not surprisingly, a higher level of debt disclosure and a higher level of comfort that we're getting a full story, and that deteriorates a bit as we go down the spectrum. But again, all the initiatives in the report and the things that we're going to talk about today that would enhance debt transparency, that will help us do our job better, and that will help the markets as well. So back to you, David.
A core problem I'll mention, and then I'll come to Carmen. A core problem is, in a lot of debt around the world, there's a bankruptcy process that is legislated within a country. And so when creditors, when a debtor is unable to pay, there's a prescribed process that the creditors can go through to both share information and then decide who's going to take the losses, and they fight about it, but they assess the situation. Whereas in sovereign lending, there's not the equivalent. And so one of the things that is complicating this, I think, is that sovereigns the people of the country are fully committed to paying all of the debts that are incurred by the government of that country forever, with no process to restructure it or force a change. And so that creates, and that maybe everyone can correct me in that perception, but to me, then that means that if I'm a lender and I'm lending only in a small amount to a country that has big problems elsewhere, I'm pretty assured of getting paid because I have the upper hand in the legal structure. If I take it to court in London or in New York, I'm going to win as a creditor because that's just the way the system works. But that's a background. Let me turn to Carmen for both comments and questions to the panel.
Thank you all for very, very insightful discussion. And I want to follow up on something Paul said. Um, you know, the issue of hidden debts is not new, and Paul, I would say it's not entirely. It's certainly, as this wonderful report highlights, it's primarily an issue for many of the emerging and lower income countries, but it's not unique to them. I mean, certainly the Greece Goldman case a few years back on hidden debts was a major surprise. Um, and it over the last decade or so, the issue of hidden debt has partially also grown enormously because non-Paris Club creditors, the largest of these is China, increased in importance. Now that's official lending, but nonetheless, it is adding to the debt servicing, to the debt and debt servicing of a particular country. And some of that debt has been restructured repeatedly. How does S&P, deal also with a higher incidence of these restructurings? And as David mentioned, since last year, the DSSI, we learned that, for example, the sovereign debt, the debt of the China Development Bank is considered private debt, which would be in the domain of credit rating agencies. So, there would be a private creditor. So how would you say that ratings have adjusted to deal with these changed landscape?
Yeah, Carmen, I'm going to get out of my pay grade pretty quickly here because I run the economics team and not the sovereign ratings team. But yeah, you're right. This is a challenge. I mean, we've got a lot of debt that's quasi public debt. It might be a non-government organization to a non-government organization, or it might be a state enterprise to another state enterprise across border. But it's something that it's something that our sovereign team has to deal with. As I said, there are ways to adjust the rating up or down if we're not happy with the transparency or the consistency of data or anything else. We do rate a large number of the bigger EMs, not the tail, because we're missing about 60 or 70 countries globally. But that's something that we try to put into our criteria, and the sovereign team tries to keep up with that. I mean, for the details, I can maybe get back to you on that. But the sovereign teams are fully aware that a lot of this debt is not directly on the sovereign's balance sheet, and it may come from quasi-sovereign or other creditors, but to the extent possible, that is incorporated into the rating that we're publishing.
Thanks. And I'll ask us to come back in a little bit to the common framework and to China, the magnitude of the China debt. I want to ask Lee if he has reflections on what we've already been talking about, and also any suggestions or corrections to the way I described the sovereign process. So one of the things we're dealing with is this fundamental gap in the global system for how do you deal with a country that has unsustainable debt. There's not really any process to do that. So we're always ad hoc, one country at a time, and that's a very expensive process. So Lee, correct me in perception, and also ask or let's go on from there.
Okay, I would amplify what you said, David. You described half of it. You said that sovereigns are not subject to a bankruptcy code, not their own, not anyone else's, and that is true. It follows from that to the extent that they have governed their debt instruments by a foreign law like New York or England, if those debt instruments aren't paid, the creditor can get a judgment against them. That is true. But at that point, the leverage usually shifts back to the sovereign, because that judgment will convey an emotional satisfaction to the holder, but not a financial satisfaction, unless the sovereign pays it voluntarily, or the creditor can find an asset outside of the debtor country that it can seize in order to pay itself. And typically, there are few such assets in the name of the sovereign itself, the republic, not state-owned enterprises, outside of the jurisdiction of the sovereign. And we have seen this play out again and again, David, perhaps most poignantly in the 15 years of litigation that followed the Argentine default in December of 2001, where you had some of the most sophisticated and aggressive, litigious, high testosterone hedge funds pursuing a sovereign around the world, looking for assets in an effort to pay themselves. And that effort was to a very large extent unavailing. So there is leverage on both sides. The creditors can get judgments, and there's very little that the sovereign can do to stop it. But once the judgment has been issued, satisfying that judgment becomes a major problem for the creditor. And candidly, a recognition of this situation is the chemistry, is the basis for consensual sovereign debt workouts. Both sides are vulnerable in the process, and therefore, in truth, neither side has a good option other than to negotiate their way out of the problem. They cannot litigate their way out of it.
Got it. Let's talk about that in the context of the common framework in a minute. Let me turn to Joyce on that point that Lee is making, that there's kind of a practicality, and I wonder if that's how you perceive it. Are there any countries? I know you're watching China very carefully for its own internal debt, but what about Argentina that is still that is working its way through a recent crisis? Do you think of, how do you think of sovereign debt as far as the safety of it? Thanks.
No, thanks very much, David. And just a couple of comments on what Lee had to say, and also on the collateralized debt as well. So, look, I think that, I often will hear, we're very disappointed in the private sector. We want the private sector to do more. And these are sort of empty statements. I think it's too much for the private sector to ask to be in the negotiating room, but they should be given the information upon which bilateral creditors have constructed their debt treatment. If you're going to expect comparability of treatment to work, they don't necessarily have to be at the table because, that makes a large political statement, but they have to be given the information and asked about their views. And I think this was some of the initial problem with the common framework. But I wanted to just say a few things on the collateralized debt and also on the China Development Bank that Carmen had brought up. Look, I think there is room for innovation. I mean, JP Morgan now allows credit enhanced bonds to be included in the EM bond indexes, but Lee is absolutely right. When we sort of conceived of credit enhanced bonds, we really did sort of think back to the days of the Brady bonds where it was Treasury collateralized. I mean, the whole issue was, is there a way that you could actually use official creditor resources and leverage that more? Because the official creditor resources are still relatively small to, EM sovereigns raising $230 billion in the international capital markets. Now, that's completely different than forward sales of a commodity as collateral. So something like that would not go into a JP Morgan index. But the question on collateralized instruments was, is there a way that you could use official credits and even things like XM credits? We have a development financing group that's looked at that. And could you require certain things like ESG sustainability commitments in return for credit guarantees? That's kind of more the way that I would conceive of the collateral. As I totally agree with Lee that some of these other mechanisms that they're looking at it, to me, they raise real questions on, who bears the responsibility and the transparency and, how you actually can enforce some of this. And then, I hear oftentimes also from official creditors a lot of discussion on these contingent instruments. And I do think like academics really love these because it's, theoretical economics that makes sense, and there's this automatic factor in it. In practice, I think that it's a lot harder to actually put that into place. So the official creditor enhancements is something that stands out. Look, I think that, Carmen brings up kind of the elephant in the room on the common framework. I mean, is this really all about China? As the largest, creditor to many of the emerging markets countries. And, this whole debate on whether China Development Bank is official or commercial, that's kind of a travesty in a lot of ways as a lender. And, the common framework was meant to overcome these issues, but in some ways, the question, has been asked, does China really prefer bilateral negotiations when they are the largest creditor? Was the lack of clarity in some ways meant to cajole China in this? We've just been going through the numbers for China, and look, what they call the private sector debt there is 232% of GDP now. So is that private? Is it quasi-sovereign? Is it really government debt? So I think that, China's really the elephant in the room, given the role that they have assumed for so many of these low-income countries as the biggest, as being really, a lot of this debt really is, something that, China has a key role.
You gave us a lot to chew on there. Okay, so one background for people is we've been talking about official debt. This is the debts of various government entities around the world lending into sovereign situations or even private situations in developing countries, or that's the way I'll use the term. And so that historically for, 40 years or 50 years has been rescheduled as a group by the Paris Club, which is a group of official creditors that used to be the major creditors around the world. So in the Latin debt crisis, the US and Germany and France and the UK and Japan were the major creditors for the Latin countries, and they could sit in a room and figure out what to do to restructure the debt. Over time, China has become a much bigger creditor than all of those others combined. World Bank did a report a year and a half ago that showed that 65% of the official credits were from China, and all the rest of the countries were the remaining 35%, of which Japan was one of the big ones at 15%, if I recall. And so what that means is that the concept of the restructuring process has changed dramatically over time as China's role became more important in that amount of debt. So I wanted to, so that was kind of background. So one of the challenges as the world looks for a process to allow debt relief, reduction of debt for poorer countries or developing countries in general where the debt has become unsustainable, meaning the creditors allowed too much debt and the countries took on too much debt, and circumstances changed and the country can't pay it. There's not a process, and so we're looking for that process. And the G20 put forward the common framework that we've been talking about. So I wanted to ask Joyce and then have others maybe ask questions, but you mentioned the term credit enhanced bonds, which is great. And so as we talk about collateral, my understanding of the problem of collateral is it's very hard to value within the structure, meaning the country gives collateral, meaning either a right to an asset or, as Lee framed it, this forward sale concept. It doesn't seem to cost the government of a country much, but over the years and over the decades, sometimes these are 20-year commitments by a government that is non-disclosed. So it's a secret commitment by a poor country, the government of a poor country, that locks the people of the country into payments that are going to last 20 years. So why would the world want credit enhanced bonds? Can I frame it that way? And you make a defense, and then maybe I'll bring Lee or Paul in on that. Go ahead, Joyce.
No, and that's why I'm trying to be clear that on the credit enhanced bonds, I really looked at it more, conceptually as whether there's a way to leverage official creditor resources in that process more so than making these forward commitments for 20 years 10 years based on, forward sales of commodities, or even, like some of these GDP linked bonds, where I feel like sometimes that is really brought up in academic circles. I find that much harder to actually, I feel like, David, you're in this environment right now where you can sell practically anything. Right. I mean, in a zero yield world right now, given that you have a 1% return on fixed income bonds. So on some of these credit enhanced bonds, I think there is a moment right now that you can get some of these done. How does the private sector look at that, or how would you look at it conceptually? I look at much more sort of the Brady plan model, where you really did have a partnership more between the official creditor community that provided the incentive for the private sector to get involved, and more of the certainty. So I think Lee, very well points out what the problem is with the structure of some of these bonds and the forward 20 years. And we see this with, a lot of like the GDP warrants, all of these other mechanisms that were put into place. I mean, that's much harder to sort of value going forward. It is something that, I feel like sometimes it is the economists who come up with these kinds of, structure, because they like, for theoretical economics, it makes sense. It injects an automatic element into it, so there isn't as much discretion. But I think that the official creditor subsidy is actually something to me that makes the most sense. I mean, and then a way that you can leverage the official creditor resources.
Got it. Now, one small point, and then I'm going to go Lee, and then Paul, and then Carmen. One small point on that, Joyce, is people look to the World Bank to provide that creditor subsidy, and the problem is we can't price it or value it. So people are looking for first loss guarantees from the World Bank. The problem is World Bank is decidedly going to be less good at evaluating the value of that credit enhancement than the private sector itself that's looking for the enhancement. So we have not wanted to go in that direction, in that it will end up in a mispricing of credit, or at least that's the view that we have. But let me go to Lee, and then Paul and Carmen on any topic. Lee?
If I may just come in on something that Joyce said. Joyce, I don't think it's just that economists are enamored with state contingent contracts. The reason they write state contingent contracts is also to do risk sharing between debtors and creditors, so that in bad states of nature, debtor countries that are able to pay less can, under the contract, pay less. So, it's, I think your vision is from the creditor side, which is perfectly understandable, but it is about risk sharing. A relevant example to COVID would be something along the force majeure, though I defer to Lee on that score.
We'll go to Lee, and I'll make a principle statement. I and the World Bank are on the side of the people in developing countries, which is a different interest. I mean, we're trying to find a way to wed that interest with creditors. I mean, the wonderful thing in the world is that there are savers who want to put money to work, and Joyce named it. They're not asking for a very high return. A risk return is favorable from the standpoint of borrowers right now, because the interest rates are so low, and so this is we're trying to put both sides together, but with a recognition, or at least our observation right now, is it's not working very well at all for the people in the poorer countries. And so that's what we're trying to look for ways to, and jointly to move that forward. Lee, any thoughts? And then Paul?
Yes, I think Joyce has raised the issue of what the IFIs could do by way of credit enhancing sovereign obligations. That is in my mind, a very different subject from the one we talked about earlier, where the sovereign or a state-owned enterprise is pledging assets or revenue streams or forward selling those revenue streams. The issue, David, that you raised, can the IFIs appropriately price or assess the value of their credit enhancement? You remember what happened in the Brady transactions? there were not guarantees by the official sector. What happened was the IMF and the World Bank lent money to the debtor countries, and that money was used to buy US Treasury, zero coupon US Treasury obligations that matured in 30 years and were pledged to secure the principal repayment on the Brady bonds. The World Bank has dipped its toe into this river several times. For example, it issued a partial guarantee of a bond of Ghana, I think in 2012. The question that we've always had is, what is the best structure for putting partial credit enhancement of an IFI on a debt instrument so that we can predict how the market will value that? You see, it ought to be possible to sit down and say, these are the terms the sovereign could borrow unsecured or uncredit enhanced. These are the terms that it will get if it has the credit enhancement. And if it turns out that it is valuable, appropriately valuable, then that becomes a sensible thing for an IFI to do. One other comment, there is rigidity in at least the World Bank's approach to this. The World Bank will treat a partial guarantee, a contingent liability, they will score it as though it were a direct loan. So to the extent the country has a certain allocation, a certain borrowing capacity from the World Bank, they'll use it up by asking for a partial guarantee, even though that guarantee may never be called. I can't hear you, David.
Without that, there's the problem of, or the challenge. The World Bank and other IFIs have preferred creditor treatment, meaning the whole world has agreed to the idea that these are senior or special creditors within the environment. And so that makes it extra hard to do. And so that's how we score the partial guarantees. Let me turn to Paul for comments on any and all of these topics.
Yeah, a couple of comments, David. First, well, Lee was talking about Brady bond restructurings, and I was having a flashback to my IMF days with, par bonds and discount bonds and flurbs. But that sort of collateral is going to be expensive now, right? Because interest rates are so low and rates were higher and prices were lower for those bonds back in the 80s when we were using those. And also comment on what Carmen said about state contingent debt structures. And obviously there are good and less good state contingent specifications. So the idea there, as she correctly said, was around risk sharing. But I wanted to come back to something that Joyce said earlier. She touched very briefly on ESG and the term in a sort of a larger context of debt. And just to point out that, ourselves at S&P and a lot of other people in the market are doing a lot of work toward ESG scoring. So we have a legacy business, as everyone knows, for providing credit ratings, but the newer business, which is getting an enormous push, is to put some sort of ESG score on entities as well. The market is trying to converge toward some sort of common framework aligned with public sector as well. We're obviously not there yet, but I'm wondering, just maybe for the panel as a whole, does that figure into the sort of the debt framework here? I've got my economist hat on. I'm not going to pretend to be a rating analyst, but if we've got some sort of collateralization loosely defined, and we know that some of the natural capital is located in some of the high debt countries, does that figure into the mix going forward as we're talking about securitization or collateral or other things, or is that a separate issue that we can always keep off to the side? I would love to hear views on that.
Let's do that topic. So green bonds are important, and then the transparency of how they're evaluated becomes very important in this, meaning what describes a green bond, and there's different views in the community of what qualifies as a green bond. Columbia recently did a bond that was, I don't want to use the term collateralized, maybe I missed, but Paul, I think we should say bonds that have extra value, let's say, because of an ESG.
Better terminology, let's use that one.
Yeah, because I kind of want to reserve the term collateral, and Lee did a good job for dividing this up into credit enhanced that are from the creditor side, and then a locking up of assets or future sales as the use of the term collateral. But what Columbia did was said it would protect. It's kind of like collateral, but let's call it extra value. They issued a bond that that was attached to protecting some huge amounts of land in Colombia. And one of the challenges for the world here is it was only 7 basis points improvement in the yield. So it was like a 7% bond that came in at 693, or 7 basis points, a small fraction of the total premium, or I mean the total yield on the or coupon on the bond. So it didn't add, it wasn't much of a premium. So let's talk about ESG. Joyce, comments?
Yeah, so I mean, there are a couple of transactions that have come out. The Belize Blue Bond is another one that recently came out, and there are different criteria. But if you look at this B3W, the Build Back Better World, they are talking about the Development Finance Corporation actually being able to take a first loss and being able to use more sort of credit enhancement. So that discussion is happening sort of at at that level. But the Belize Blue Bond is another level. If you just take a look at the green bonds this year, I mean, there's a tremendous amount of investor demand. Year to date, there's been 360 billion of issuance of green bonds. For all of last year, it was 300 billion. So I think there really is room for innovation here, just given what the investor demand is, some of the requirements also to demonstrate that you're in these instruments, and looking at creative ways in which this could be structured. So
how do you do transparency? I saw the article in the front page, big one in the Washington Post yesterday, saying the data is I forget the headline, but it was that there are huge problems in the data collection. In the World Bank Climate Change Action Plan that we did in April, a central point of that is the need for diagnostics as far as what the actual greenhouse gas emissions are from a given activity, or what the size of the problem is in various parts of the climate space. But the Washington Post article yesterday took note that that it's very difficult to do transparency in this field. Joyce, any thought on that?
No, I mean, the transparency, and that's why I really do applaud the World Bank's debt transparency report, and also just all the work that Carmen has done for just decades about this topic, and also trying to look at something really complicated like China's debt transparency and how we look at the hidden debt. It is really difficult. I mean, look, a lot of the ESG issues that we work on are just very hard to quantify, period. I mean, whether we're talking about the issues related to debt, or we're even trying to make, forecast out about, government programs and what the realistic way is to measure pricing, the cost of decarbonization, and other metrics. So I think this is only, this problem is not going to go away. It kind of identifies the biggest risk you have with ESG is that it's been very hard to standardize anything and put this into sort of a standardized contract.
We may want to save this topic for another panel, and I want to kind of gradually bring us to the common framework and the actual challenge at hand. This is a huge amount of debt on the developing countries, and especially the poor countries, and how do we restructure it? Carmen, thoughts at large or questions, either one?
Let me start with the transparency and the common framework. I think one area where the multilaterals can play a big role also is actually on the setup of transparency. Transparency is not going to bring about automatically creditor agreement. That's pie in the sky. But for creditor committees to actually come in with more cohesive view of what the actual liabilities are, what the contracts look like, is at a minimum. And here I will defer to Lee, who is, infinitely the authority on this. But I think as a minimum starting point, starting the discussions from a common ground on who is owed what and what the terms are is sort of a minimum minimorum core. But let me say that on the common framework, I think it's a necessary first step. It's necessary in two ways. One is it is a recognition that the problem for many low-income countries, and indeed for not an unsubstantial number of middle-income countries, is has to do less with liquidity, but more also with solvency. So you have to move from the DSSI, COVID emergency to something that actually delivers some debt relief. Having said that, and what I think the Common Framework has done is basically transfer the Paris Club to the G20, so that the non-Paris Club members, China, Saudi Arabia, UAE, and other non-Paris Club creditors are part of the discussion. But let me, perhaps I'm being overly pessimistic, but let me say that I recently did a study called Sovereign Bonds Since Waterloo, and the chronic common theme is creditors want to be repaid in full. Debtors want a haircut because they perceive their ability to pay as impaired. And so getting those two sides together, which is the task we have ahead of us, getting those two sides together has historically taken a long time. And things like, the Brady plan, that Joyce mentioned and has been mentioned, that came a lot later. That came years after the onset of crisis. So I think our main task would be to, try to expedite what has been usually a very long process. Let me stop
Great.
there.
I'll come to leave for an answer to that, but I want to pick up on one thing you said, that the inconsistency, or I think there's a third problem. It's that the creditors want to be paid in full, right? The debtors would like a haircut, but the people of the developing country need the advancement. And so I want to kind of make it more of a triangle. There's the interests of the governments of the borrowing country, the interests of the creditors, and then it's a little bit separate, the people of the country, because if I'm the government of a poor country, I'm happy to sign away the rights to oil or to cobalt or other things for 20 years, because I won't be around for 20 years. I just want things to go well over the next 4 years. And if someone comes in and says they'll build roads and they'll pay people a stipend for the 4 years, then I'm willing to sign away a lot of future value in order to get that. So I really think we have to take into account the different interests of the people of the poorer countries as their governments sign contracts. And that's really the core of why we need full transparency. Unless you know what's in the contract, no one is in a position to actually evaluate the people's interest of the country. I want to come to Joyce. Joyce raised at one point the need for the private creditors to see the information from the official analysis that's done. And this is a practical issue in Chad, for example, because Chad asked for common framework treatment. So that's the common framework is something offered by the G20. They wrote it down. It's in the communique. It says that private sector creditors should and I guess are urged to participate in the debt reduction for Chad on the IMF and World Bank view that Chad has an unsustainable amount of debt. It was taken on by previous governments and it's very large. So the idea is, how do you provide debt relief on a comparable treatment basis? And I think Joyce was saying the official sector needs to share the information with the private sector, maybe not in Chad, but in the general case. So I want to ask Lee about that. And then some of the things we're pushing for in the common framework are, one, that it operate faster, which goes to Carmen's point, there needs to be some kind of speed to it. Two, that there be comparable treatment among the various creditors. Three, that we consider a standstill on payments to creditors in order to expedite or to facilitate the process of restructuring or of debt relief within the country. And four, that there be clarity on, while it's called the urging to the private sector to participate and to China's various entities to participate. So Lee, can you unpack all of this for us?
A little bit of it, David. Look, the common framework, to the extent that it brings into the tent traditionally non-Paris Club creditor countries like China and India and Saudi Arabia, I think is an altogether commendable thing. In the past, a sovereign debtor had to negotiate with the Paris Club, with non-Paris Club bilaterals, and with commercial creditors separately. This is an effort to streamline that. It was 1 year ago that the G20 announced the common framework. 3 countries signed up pretty quickly in the early part of this year. To my knowledge, we've not seen the bilateral creditor committees for any of these countries come out with debt restructuring terms. Now that, to my mind, is absolutely inexplicable. It isn't that hard. Now, you might say, well, we've had this extraordinary boom in commodity prices, and so in oil in the case of Chad, copper in the case of Zambia, that have, some might say, have rendered the debt sustainability analysis that were prepared earlier this year by the IMF obsolete. Oh, okay. But we've not seen an announcement of debt restructuring terms, and therefore the issue that Carmen raised, the so-called comparable treatment by on the part of private sector, we haven't actually had an opportunity to pursue that. One or more of these countries are going to have to announce debt restructuring terms, and then we will see whether the private creditors are prepared to provide comparable debt relief. And I don't want to prejudge where that comes out. But the disappointment with the common framework, I think, is principally the fact that it has not produced yet a single debt restructuring. And to the extent that many people put a great deal of significance in the common framework and the collection of bilateral creditors into a single negotiating forum, the fact that it's not produced anything really is a disappointment. On your point, David, what you have proposed, a debt suspension during the common framework negotiations, I think is a very good idea. What it effectively does is extend the DSSI for those countries that ask for a common framework debt restructuring during that period. It will both motivate the creditors and the debtor. It motivates the debtor because you do extend the DSSI suspension, and that will, I think, induce more countries to ask for a common framework debt restructuring rather than put it off. It also motivates the creditors because they will not be receiving debt service payments during the negotiation period, and therefore they will want to get on with the negotiation. So that is all good. One final comment. but you've said it a couple of times, David. You use the phrase debt reduction. Remember that the common framework had a sentence which said that debt reduction, debt cancellation, debt write-offs are to be considered only in the most extreme cases. And so it is not clear to me whether these bilateral creditor committees will be proposing principal haircuts as part of these debt restructurings, or whether it will simply be a maturity extension, maybe some interest rate relief, but I fear it will be the latter. And for many countries, as Carmen says, it is not a liquidity issue, it will be a solvency issue.
Yeah, there's a real world consequence to this that people should be aware of, that in the midst of the pandemic, even the poorest countries are basically paying every month or every quarter to creditors in wealthier countries, generally in much wealthier countries, with no actual prospect of that changing. World Bank works very closely with the IMF. We discussed this jointly with the G7 and with the G20, and I explained to the G20 leaders just over the last 2 weeks that the process is fully stalled, and we've made suggestions on ways that it could be reignited or made more effective. President Biden was in both Glasgow and Rome, and I saw him in meetings there in the US, has been strongly supporting the idea of transparency. So I really welcome that. I think that's a critical part of this in order to move it along, because then you can take into account the fuller value of the debt, and you're working with better information. As a by the way, for people, for Chad, it took almost a year to reconcile the amounts of debt, meaning normally in a bankruptcy committee process for private sector creditors, they share information and can quickly figure out who is owed money in which kinds of forms. But for Chad, it's a very poor country going through difficult circumstances. It took the creditors a year to figure out how much they thought each were owed. And as Joyce may be indicating, this information is not always shared very fast with the private sector creditors. So it makes it difficult to actually get to an end point in some kind of debt relief process. So my end point on this is the real world consequence is there's speaking of the low income countries, $860 billion of debt in the midst of the pandemic, almost all of which, or the vast majority of which, is getting serviced regularly by the poor country. So the World Bank puts in huge amounts of grants and zero interest rate loans to the countries, and the money turns around and goes to creditors in a lot of cases. And so we're facing that, and we're just strongly encouraging the world towards some kind of process to break the spiral that's occurring. Okay, so any other comments? And then I'm going to read questions from the audience. Does anyone want to intervene right now? Okay, then I'm going to ask a question. Let's talk about the debt itself. The amount. So the World Bank has a report out, and let me put this to Carmen, which parts of the world are responsible for publishing information about that, and is that process working pretty well? I bet S&P, maybe Paul will comment on that, but who publishes data and who arbitrates that publication? I know you're famous in this field, Carmen.
So David, historically on external debt, the World Bank in the debt reporting system has had, the longest, most established history. And don't say that because this is a World Bank conference. This has been the norm since, for decades. However, I think a big challenge on on, but there are also series that the governments themselves publish. There are also alternative series that academic studies and other agencies publish. I'm gonna speak to that in a minute because I think it's very relevant to the transparency discussion we've been having. But one of the elements of the recent the more recent challenge is that as borrowing becomes more complex, more borrowing of governments is state-owned enterprises, more borrowing of governments are special purpose vehicles. Also more borrowing of governments is domestic debt. It's really important for governments to have consolidated public sector accounts. In a recent survey we did at the bank, it shows that 54% of the respondents do not have consolidated fiscal accounts. And so getting an overall, what I'm saying is getting an overall public sector indebtedness picture that also includes new types of debts, like from central banks, swap lines, or government deposits, or repos and other instruments that have become part of the new public debt universe. That's become increasingly important, but at the same time, many governments don't provide it. So in answer to this question, I would say that we are at a critical juncture, and very much this is also in the spirit of the report, which gives a list of recommendations of what to do to improve transparency. I think the multilaterals also have to go beyond just much beyond receiving data from the governments themselves, which may be imperfect either because they don't have consolidated accounts or because of disclosure requirements that they do not disclose the debt, to go to other sources from the market, sources from academia. So I think a big push forward on the getting better debt data than the one, say, historically. There is the World Bank, BIS, IMF Data Hub. Going beyond that to draw on other sources is going to be increasingly important because of all these other types of borrowing that are comparatively newer.
Paul?
Yeah, David. David, let me second that. Yeah, so the S&P Sovereign team doesn't have a crystal ball, so we use the same data sources as anyone else. And when we go visit a country, it's almost like a mini IMF Article 4 mission, right? We send a team out there, we get the official data, we talk about macro policies, we look at the debt, and as Carmen says, sometimes due to capacity constraints or other reasons, that debt is not complete, and then we go to alternative sources. But I think we would definitely support any effort to increase debt transparency and let the sovereign teams do their job. And the world's moving quickly, not just with some of the contingent liabilities and off-balance sheet stuff that Carmen talked about. We've got these global digital actors now, and we're going to be increasingly in a world where we've got a lot of digital debt with smart contracts and a lot of things that are going to be customized and not homogeneous and tough to aggregate and tough to do under surveillance regimes. So I think staying ahead of that game is going to be increasingly difficult. But again, we're using the same toolkit as the IFIs, and I think we would definitely support all the improvements that we're discussing today.
Super. We've got about 5 minutes left. I wonder if we can focus on, historically there were, so the question is on collective action clauses. Did they work? Are they working? And are there ways to extend them? And are there other ways to improve the system? So this is kind of a forward-leaning question. So, and I want to ask, I guess, Lee and Joyce on that. Well, Joyce first. Did collective action clauses work, and are there ways that those could extend into other kinds of contracts?
No, I think the collective action clauses were, a real success, and we can talk more about this. And I would just say, the fix for contractual loopholes is not to tinker further with the bond contracts, because there are always very clever lawyers on the other side. I think it is really to simplify and try to standardize bond contracts rather than to make them more complicated. But I also just wanted to add the point on the debt transparency. I mean, look, the role that the official creditors really have just been sort of a stalwart at has been a lot of the technical assistance. Whether it's from the IMF or the World Bank. So I think on this whole issue of debt transparency and consolidation of debt accounts and reporting of it, it seems to me like we've had these discussions. Well, what exactly can the official creditors do? There's a line on how you can use guarantees, and all of that is understandable. To me, the technical assistance piece of it has always been critical to the private sector in the debt restructuring, whether it was the lowest income countries or whether it was the Eurozone. In the IMF examples with Greece. So I think that the technical assistance, I wouldn't downplay just the credibility that the official creditors have and the way that they can sort of access this and put all of the brain power together is something that is really, unique and valuable, and I think can really help in these discussions in making sure that, people are using this uncommon information that's transparent. But I would just say collective action clause is a success, but simplifying consistency in the bond contracts, standardization, I think is key.
So we have, there has been mentioned today the Greece issue and the central bank swaps. So DRS is trying to comprehend the effective options, and of the central bank swaps have been included in the World Bank's DRS as a form of debt. And so, our reports now use the concept of debt-like instruments in order to get a broader view. Lee, any final thoughts on either on the simplification of the bond contracts, as Joyce mentioned, or on collective action clauses, or on what governments could do to make this process work better? Maybe the UK government or the US government. Any thoughts in that area?
Entirely with Joyce. Collective action clauses have been a considerable advance, and they have helped achieve orderly sovereign debt workouts over the last 10 years. Most recently, a few weeks ago in Belize, where Belize used its collective action clause in its international bonds in order to achieve a retirement of those bonds, but only up to a point. The collective action clauses are only in bond contracts. You don't even find them in syndicated loan agreements. They are not a panacea, as we saw in Greece in 2012. Greece had 35 English law bonds, each with a collective action clause. Only 17 of those series of bonds joined the restructuring. They are not a panacea. And the market has adapted to them so that determined holdout creditors can get blocking positions in the bonds and thereby stymie the use of a collective action clause. The question is, do we do anything more? There are those who are arguing, David, as you have just alluded to, that we should resurrect the idea of a statutory sovereign debt restructuring mechanism, perhaps not as aggressive as the sovereign debt restructuring mechanism the IMF proposed in 2002, but some statutory intervention, at least in the jurisdictions like the United States and the UK, where most of the cross-border emerging market sovereign debt obligations are governed. Difficult because it obviously is a political decision, but not impossible. And the UK did something like this, a modest measure back in 2010 in the context of the HIPC initiative. I think there are other things that one could do, but probably that's another phone call.
Lee, that was great. I'm being, we have the hook to close. This was a really great panel, raised a lot of issues that we can focus on. Just to close, I think because we don't have a fix for all of this, and there is a joint interest between creditors, between the governments of the debtor countries, and between the people of the debtor countries in getting new investment. Everyone has to, in a way, work together on this to make it better going forward. So that's the point of our transparency report. It's called Debt Transparency, and it's on the World Bank website. And I want to greatly thank Carmen Reinhart, my colleague at the World Bank and chief economist here, Lee Buckheit, Joyce Chang, and Paul Grunwald for the great panel. Thank you, everybody. I'll say goodbye. Thanks all.
Thanks, everyone.